Hi, I'm going to go through and walk through the exercise 16-14. ProWeave manufactures stadium blankets by passing the products through a weaving department and a sewing department. The following information is available regarding its June inventories. So you can see it has the different inventory accounts with their beginning and ending balances. The following additional information describes the company's manufacturing activities for June. So it tells us raw materials purchases, factory payroll, other factory overhead costs, materials used, labor used, overhead rates, and it tells us what we sell the product for. So we are asked to compute the cost of products transferred from weaving to sewing, cost of products transferred from sewing to finished goods, and we know that as cost of goods manufactured, and then the cost of goods sold. So I've set up some T accounts here, and you'll see the next page gives you the actual tables if you want to do it that way, and the journal entries. Those are pretty self-explanatory as far as the journal entries. I'm going to be walking through the different items that we have and how it applies to the inventory accounts. That's how we determine what the journal entries are, the numbers. Okay, so I'm going to go ahead and put in my beginning and ending balance. If I can guess where the numbers are. So materials has beginning inventory of 120,000 and ending inventory of 185,000. So I'm going to do the same thing for the two work in process and the finished goods inventory. So as you can see, I have all of the inventory amounts listed. So now we're going to go through the additional information to see how it affects our inventory accounts. So we have raw materials purchased on credit, 500,000. So that's going to be a debit to our materials account. Factory payroll costs paid in cash, we don't necessarily need that. What we need is the amounts that go to the inventory account. So the materials used, direct for weaving is 240,000. So we know work in process is going to have three cost components: direct materials, direct labor, and overhead. So we're going to add the direct materials for weaving and the direct materials for sewing. Of course, those are both going to be debits. Then we have the direct labor used for weaving and for sewing. So again, those are going to be debits. To our work in process accounts. Then we're going to add the overhead. So it tells us we're going to calculate the overhead as a percent of direct labor. So for weaving, if we take the direct labor of 1,200,000 times the 0.8 or 80%, we're going to get $960,000 for overhead. For sewing, if we take the direct labor of 360,000 times 150% or 1.5, we're going to get 540,000. So if we want to determine the amount that was transferred from weaving, so it was finished in the weaving department, so it would be a credit here, and then it would be a debit to the work in process sewing. We're going to add these amounts up, so we're going to add beginning inventory plus direct materials plus direct labor plus overhead, and we're going to subtract our ending inventory. So that's going to tell us the amount that was transferred to sewing, 2,370,000. So we're going to add that as a debit to our work in process sewing. Then we're going to determine the amount that was finished. It leaves work in process sewing as a credit and it moves to the finished goods inventory as a debit. To calculate the amount, we're going to take beginning inventory plus direct materials plus direct labor plus overhead plus the amount that came from the weaving department. Then we're going to subtract our ending inventory. So we're going to determine that our cost of goods manufactured is $3,215,000. So that's going to be a debit to our finished goods inventory. So to calculate the amount then at the end of the month that is sold, meaning it leaves finished goods inventory, it leaves our balance sheet, it leaves our facility, and it's going to move to the income statement as cost of goods sold. So to calculate that, we're going to take beginning inventory plus cost of goods manufactured minus ending inventory, and we get cost of goods sold of $3,275,000. So we're also going to show the debit to cost of goods sold. So that's one way you can work through the accounts. There's a couple other things that it gave us. We didn't really need it to be able to answer the questions, but if we wanted to determine the amount of direct materials used in total, we could take beginning inventory plus purchases minus ending inventory, and that would give us the direct materials used. So again, that's one way to calculate and show the movement through the inventory accounts. You can also do the same calculations using the table. So you would do it for each department, the weaving department, the sewing department. So these would be your work in process. And then of course your finished goods, you're going to get the same dollar amounts. And then your journal entries. So as we showed in the T accounts, when it leaves weaving and goes to sewing, it's a transfer. You're going to debit, of course, your inventory account that's increasing. They're all assets, and you're going to credit your weaving account. When it's finished, you're going to debit finished goods inventory. You're going to credit work in process inventory for sewing. And when we sell it, it gave us the amount that we're going to sell it for. So this is your sales journal entry. And then this is your cost journal entry to show that the cost of goods sold was $3,275,000. And that's the end of our problem.